Hey everyone, Douglas here, and welcome back to the MMT Macro Trader. Today we're going to discuss inflation, kind of all things inflation. What's causing inflation, at least from a theoretical standpoint? What might stop inflation? Where does the status quo get inflation wrong? I mean, all things inflation. That's what we're going to discuss. And we're going to hit a lot of different topics and try and come to some sort of conclusion, at least get some sort of insight on the core drivers of inflation and kind of what to expect with regards to inflation and the rest of the macro economy. Spoiler alert, I don't think anyone has the right answer on inflation. I mean, I think inflation is a very tricky topic that no one has exactly figured out. But I do think that the framework of MMT probably gives the best answer. And we'll just kind of go from there. It might be a bit meandering, but I have a lot to share. And like I said, I haven't seen anything where when you work through the math, when you work through the correlations you'd expect to see, given various arguments, that has ever said, yep, this is the underlying factor to inflation. If we just fix this, or policymakers just did this, or whatever, inflation wouldn't happen and any detrimental effects wouldn't be there. I don't think it's that simple, but I do have some stuff to share. I think some stuff very unique that's probably not out there, and hopefully can be a bit of illumination to the overall inflation discussion. Anyway, we'll get into things real quick. If you're not subscribed, make sure you get subscribed. Turn on those notification bells as well. You won't miss an update going forward. And then if you find this video particularly helpful, give it a thumbs up on the way out. Helps the algorithm, keeps me happy, all that good stuff. Anyway, let's get into things. Not earlier this week, a couple weeks ago now, I believe I posted this chart here on my Twitter feed and effectively made the base case for kind of the MMT base case for inflation. This is the case that Warren Mosler has been making for many, many years, effectively that there is a term structure of prices via the effectively the borrowing channel, if you will, or the cost of doing business aspect in the sense that as interest rates go higher, that causes the cost of doing business to go higher. This pushes the velocity of money higher. This is kind of an insight that I don't know if Warren Mosler has exactly seen. This chart in front of you. This is, to me, the necessary conclusion, the next step in the thought process here, but that pushes the velocity of money higher and therefore is an inflationary cause, right? So this is a channel inflation. And from an MMT perspective, it's kind of a key point here, from an MMT perspective, and I won't take the time to really spell out every detail of this, but from an MMT perspective, we all think that, or it's a kind of a core belief that it's the Fed that sets the interest rate, right? It's the Fed that is the monopoly price setter of the interest rate. And so effectively what the yield curve is just an expression of where traders think the Fed is going to set the interest rates. And that if the Fed didn't set the interest rates, that the natural rate would be at zero. L. Randall Wray has a couple of great clips out there, the 3-4 minutes. I think if you look up something like Deficit Owl or something like that, Randall Wray interest rates or Fed interest rates, you can find a few minute clips that really spell out kind of the base case for that. I think it's a pretty ironclad argument, and I think definitely the data bears that out. But with that kind of key piece in mind, then if the Fed is the monopoly price setter of interest rates, and the interest rates will follow whatever Fed policy is, and whatever the Fed policy, or at least what the Fed is saying that they're going to set the interest rate at in the future, then that will affect the entire curve. And so therefore, as the Fed raises rates, this is actually an inflationary push, right? And it's part of the inflation channel where inflation will effectively come from, if you will. And the chart that I shared is the Fed funds rate overlaid with the rate of change or the velocity of the rate of change of the velocity of the money supply. Now, I did use MZM, which I think is the best, at least used to be. It got deprecated back in 2021. It was the best measure of money. Either way, even though it got discontinued in 2021, the correlation still stands, and I think it is the Fed dog that wags the inflation tail, and not the other way around. And so as the Fed is continued, and again, what this chart is trying to show is the correlation, right? The chart isn't necessarily trying to show anything else other than the correlation between the Fed funds rate and the velocity of money being an important component to inflation. Obviously, the more turnover of money there is, the higher inflation there is. I don't have any disagreement with that aspect, at least, of kind of the inflation definition. And so what this chart is trying to prove is that, yeah, look, the Fed is causing the interest rate, or is causing the inflation, at least through this channel, right? Now, I'm not saying there are other channels that can cause inflation. I'm not saying that the money printer isn't potentially causing inflation, but I do think this is the main channel right here. And I think especially, and I'll get to this point in just a minute, but I think this is the main channel, and the rates that we've seen push higher, especially over the last 6 months to a year, have been the main channel that have been pushing inflation higher. Now, a very common argument is that the main problem with inflation and the main driver of inflation right now is the money printing, right? A lot of people have money printing, the whole concept of money printing wrong. If you're in the camp that what the Federal Reserve has been doing with QE is money printing, you're just wrong. I mean, I've got a lot of videos on my channel. Check it out. Basic accounting. It's an asset swap. It's not money printing. If anything, it's money deletion, because treasuries are more valuable and accrue interest as opposed to reserves. So it's just an asset swap. That's not money printing. What is money printing, though, and where I would agree, is fiscal spending is money printing. I mean, that's true money printing, and until tax season comes, that's money season, or that's money that stays out in the financial sector, right? So that is money printing. And what I want to show is, and let me jump real quick before I show the fiscal flow here, but let me point out that the overall CPI has continued to rise from the May lows right after the COVID crisis in May of 2020. We continued to see a push higher in CPI that entire time. Brief pause around July, August of 2021, and we've continued, and we're still quite high right now from a CPI perspective. Keep those dates in mind as I switch over to the 180-day average flow of or average net flow of the fiscal flows. Okay, and this is something that I calculate on a weekly basis. This is really the bread and butter, the core, the best correlated data element to forward returns in the S&P, but it can also give us a good picture of what's going on in the macroeconomy. So you can see the 180-day average after the COVID financial crisis absolutely shot higher. No doubt about that. And certainly the surge that we saw in response to the COVID, at least in response to the financial crisis that came from the COVID pandemic, caused some inflation. I won't deny that. It's inflation that I think it was a pill better swallowed than the other alternative at that given point. And so from that perspective, at least from a policy perspective, I don't think there's any real justifiable argument you can make that this wasn't necessarily worth it. But notice that, and I've highlighted this point, that at least we peaked in December of 2020. And then since then we had a pretty precipitous decline back to kind of more normal range. Now, granted, I mean, we're still relatively higher, but both, really the spending fell off for the most part in terms of kind of that daily average over time. And then really it was the tax season of last year that finally hit, or early this year that finally hit, and really brought things back down to kind of a more normal trajectory. The big thing that I want to point out, though, is that the main spending surge finished in December of 2020. So we'll call it the end of 2020, right? And through the majority of 2021, we saw a decrease in those average flows to the point where we saw a massive decrease starting all the way, say, in March, April, May of 2022. And if we go back to the CPI, during that entire time, we've just continued to see CPI push higher. My argument would be really from maybe early 2021 forward, that the majority of the inflation that we've seen is not from the channel via the fiscal flows, but instead from the interest rate getting pushed higher. Okay, and that is what has been perpetuating the inflation that we've seen for the better part of a year, and really kind of the main damage that's being done. And remember too that CPI is a rate of change measurement. So, I mean, obviously, we went from almost a deflationary CPI to a sudden surge in terms of the rate of change. Is a bit relative. Either way, CPI as a measurement of inflation continues to push higher, and I think the best explanation of this, at least over the last year or so, is because of the interest rate channel. So let's start connecting some dots here. When does this end, and what are the implications of this? Because kind of conventional wisdom would be eventually higher interest rate should slow down the business cycle, should stymie borrowing, and eventually we should see some collapse in the economy. And that's the hope, right? Is that eventually we'll see some unemployment out of all of this, and that's the main goal. Despite how just terrible policy that is from just a public good perspective, even then, this is where I begin to think, I don't know if that will actually happen, right? Because I mean, in and of itself, businesses, assuming that, I mean, let me go back and let me try and articulate this the best way possible. Let me go back to this. Whoops, we'll go to that chart in just a second. But if the velocity of money is increasing, right? I mean, it means the turnover of the overall kind of stock of money is increasing at a faster rate, right? So if that's true, and if interest rates push that higher, right? So we're getting that turnover even faster. That means that businesses not only are having to spend more, but they're also getting more in at a faster rate, right? In theory. I mean, I realize in this moment in time, that might not be exactly the case. Maybe we are seeing some deflationary pressures from elsewhere, at least disinflationary pressures from elsewhere. We'll cover that in just a second. But at least the theory that says, yep, this is just going to end the business cycle, I don't know if that's necessarily the case. I mean, all things being equal, if you just increase the velocity of money, not only are you going to be paying your employees and the cost of borrowing more, right? I mean, yeah, those prices are going to go higher, but you're also going to get that money back in terms of circulation even faster. So I don't see necessarily, and maybe this is where if you're looking for some sort of master's or dissertation work, if you want to do kind of the hard work of going through all the data and proving this out one way or another, this would probably be a great topic to do it on. But I don't know if that's necessarily the case, right? And so, I mean, the question is then, what will end the business cycle and what will be the outcome of inflation? In the 1970s, it really was deregulation, right? In the 1970s, a lot of the push of inflation was because of the oil embargo, and then it was Jimmy Carter deregulating natural gas, which allowed natural gas to come into the market and undercut the price of oil and then bring down the inflation. I know Paul Volcker will always have always win the medal for breaking inflation, but that's not absolutely not what reality was when that played out. And so maybe something similar like that might happen, right? I mean, we're seeing a lot of signs of kind of disinflationary pressure from. I mean, I'm seeing like a lot of good data coming from like the Baltic Dry Index and other shipping statistics that show that we're seeing a major slowdown. Maybe that's the channel that we'll finally see. Maybe that's an indication that some of the supply chain issues that we've had, which I really think is probably what kicked off this entire event in the first place. Maybe those are starting to slow down. So maybe those are some of the factors that might finally bring some sort of conclusion to the inflation. But as long as we see interest rates push higher, and we don't get the signals that the Fed needs to go ahead and start to draw back those interest rates or take the foot off the gas of the interest rates, I think we can assume that inflation will continue higher, right? And what is the Fed ultimately going to look at? They're going to look at things for inflation. They're going to look at effectively the inflation channel that comes via energy and cost of goods in terms of their interest rate decision. They're also going to look at growth, which is effectively profits, stock market growth, that sort of thing. And then they're going to look at employment, right? So at least at this point, kind of 2 out of the 3 have definitely taken a bit of a hit, but overall employment's not doing too bad at this juncture. And again, I don't necessarily know if employment and the wage pressure that they see is an inflationary pressure are necessarily drawn back per se. So effectively my argument is this, and this came up in the Twitter discussion as well, and why I'm kind of lingering here is I just don't think that there's enough data to know, and my gut feeling is if fiscal flows stay relatively strong, they pick up, and we see at least normal continuation of kind of economic conditions after kind of the collapse we've seen over the last 6 to 9 months, that we can have at least a stable enough, dodge a kind of financial recessionary environment for long enough where if the Fed decides not to take their foot off the gas, that interest rates could just keep on going higher without necessarily crashing the economy. So there is that aspect to it, and I don't think there has to be an end game to all of this. What I do think, though, is, I do think a reasonable way that this could end, or a reasonable kind of scenario that would play out to see the inflation end is, instead of a domestic U.S. recession, is we do end up seeing a recession from the rest of the world. And I think this is likely what is playing out kind of already, and I think we're seeing the signs of this play out. And the question is, will there be enough of a knock-on effect to get that data into the big kind of key indicators that the U.S. looks at, particularly U.S. employment and the wage pressure from U.S. employment, to be enough of a signal for the Fed to take their foot off the gas? One of the reasons why I think this, that we're seeing, it's not that not that great of a revelation here, but one of the reasons why I think a major global recession is imminent. Again, I don't know if this is necessary, but really I shouldn't call it a global recession. A rest of the world recession is imminent, is what we're seeing right now in the dollar index. Let me explain this just briefly. And this is where I think maybe the argument that hiking interest rates might cause a slowdown in business activity. Well, the U.S. has this reinforced feedback loop of interest rates into inflation. Because of the kind of endogenous money growth system that the U.S. has, I think this can be sustained. And again, I think some research should go into that, be a worthwhile kind of academic endeavor. Where this isn't true, though, is in the Eurodollar system and the global financial system. They have a much different system than what the U.S. has domestically in the way that they bank, right? Because what the global system is there are dollars that are on reserve in the global dollar deposits that are on reserve in global banks, and then they use that effectively as the collateral along with other dollar-denominated assets to create new loans from, to expand the kind of the risk asset, the balance sheet of the banking system for the rest of the world. So again, this is how the banking system operates outside of the rest of the world. Inside the U.S., it's endogenous. Outside, it's kind of more of a money multiplier style of system. And so that bank balance sheet capacity is expanding, and interest rates then will potentially be an impediment to borrowing costs in a manner in which they're not, given the distinction between the endogenous cycle and then what we'll call just the money multiplier cycle. And the way that we can tell that the rest of the world is having kind of a banking crisis is via the dollar, right? Because if you think about it, it's really a short squeeze that we're seeing as the credit cycle expands, right? So we see what we'll call kind of global growth is the rest of the world banking system, the Eurodollar banking system expands. What that actually does is that puts downward pressure, because it's almost a synthetic short. If you get a loan, those dollars are being created. If you get a loan, again, big distinction. If you get a loan outside of the U.S. in the Eurodollar system, so you're getting a loan of dollars in the Eurodollar system and expanding that balance sheet, that is suppressing the dollar price. It's creating new money, suppressing the price, and then on the end of that cycle, when those loans have to get paid back, you end up having to go get the dollars, and then there's this short squeeze that happens that kind of crunches the banking system. We've seen this play out. Got 4 or 5 times, maybe 6 times now since the great financial crisis, when the Eurodollar system really kind of broke. And Jeffrey Snyder with Alhambra Partners, I believe he's still with, has a ton of great stuff out there you can look at and listen to if you want some more details on the exact mechanics of that system. But suffice to say, when we see the dollar take a sudden shot higher like it has been, this is an absolute symptom of a breakdown in the Eurodollar system that is likely this is likely the signal to a rest of the world recessionary crunch. The question is, does this hit the U.S. or not? And at this point, I don't see why it has to. I mean, and this is the kind of concerning inflationary death spiral argument you can make. The situation that I never thought could happen is kind of playing out, right? Because we have sufficient fiscal flows, right? We have sufficient fiscal flows. I expect them to continue to kind of get back to at least a strong normal, better than or higher than we saw back in the pre-pandemic age. Another thing is, at this point, we are still continuing to see relatively strong employment data, relatively strong average hourly earnings. We're not seeing the symptoms that you would expect to see when the banking system domestically in the U.S. is having the sort of issues that's consistent with a true financial sector recession. We're not seeing that yet. Could it produce itself in the coming future? Absolutely. But as of right now, I don't think we're seeing that. What we want to see is a big surge in average hourly earnings with a kick up in unemployment. Obviously, the data is very skewed because of what happened during the COVID recession, but that is, generally the path that we see heading into a recession. Maybe we're getting close to that at this point. I mean, we're still seeing heavy pressure from average hourly earnings that is, at this point, not exactly clipping away at corporate profits. That's a Steve Keen model stuff. Again, I hate to send you other places. Steve Keen would be a great person to look at that can kind of explain this in more detail if you want to Google him and his theory of debt deflation. But I think from that aspect, I even have a video, 3, 4, maybe 5 years ago now, if you look on my channel for Steve Keen, that explains that in more detail. But I don't know if we're quite seeing the science quite yet. This is going to be, a factor in risk assets or expansion of the balance sheet. So this is what we need to see to really get the sort of slowdown that would be necessary for the Fed to take their foot off the gas. So I think we could be in a situation where the Fed continues to see relatively high inflation caused by its raising rates that it doesn't understand is actually causing the inflation to occur in the first place. We don't get a severe enough domestic recession because of the fiscal flows remaining supportive enough of the economy. And we just fit in this weird quagmire of enough growth, high enough employment rates, and steady enough income flows for the Fed to say, yeah, we need to keep hiking rates. So I think the one hope for an end game to inflation is the channel of a global recession, or again, I should probably qualify that rest of the world recession, pulling enough drag on the economy to eventually say, yeah, the Fed will take its foot off the gas, but we'll see. We'll see if they end up reading it that way or not. I mean, that's kind of how I'm seeing things at this juncture, and kind of the argument I have to make for inflation. I really hope the big takeaway here, more than anything else, is the discussion of inflation is and the impact of inflation on the macroeconomy is very tricky here. And certainly a lot of the outcomes that I know a lot of the kind of, inflationary worrywarts, if you will, of years past have spouted have just been completely, the incorrect outcome, right? I mean, we haven't seen gold take off. We haven't seen Bitcoin take off. The dollar's flying high again, because I think the main driver of inflation, the main cause of inflation, is this term structure of prices that is set by the underlying setting of the interest rate by the Federal Reserve, pushing the forward or pushing prices higher into the future. And that doesn't necessarily, that process of raising interest rates doesn't necessarily cause business expansion to give way. So yeah, we'll see. I mean, we'll see. Maybe there will be a pullback. Maybe there will be a soft landing, or maybe we will just get this kind of continued push higher, or at least relatively high inflation for some time, while we just kind of tread water as these waves continue to hit us. So that is kind of what we'll have to wait and see. Anyway, like I said, this was a bit of a meandering discussion, but I do think it was it's hopefully a good discussion, a worthwhile discussion, a lot of points to think about. And if you're new to the MMT world, hopefully a bit eye-opening as well, and a bit helpful. If you have any questions, again, I took some notes, went over some ideas, but if you have some questions, need some things explained, ask them down in the comment section below. I'd be happy to discuss this in more detail. I'd love for smart people to also be thinking about this as well. In and of itself, does it directly affect my trading decisions? No, I've got models that help me stay in the right lane there. But it is nevertheless kind of an important topic to really kind of grasping the next major major macro steps, macro outcomes of the global economy going forward. So it's definitely worth thinking through and figuring out. Anyway, I will wrap things up here. Don't forget to subscribe on the way out. Hit the notification bell as well. And if you are an active trader, active investor, you can watch my stuff, make sure you check out my Patreon page, patreon.com/MMT macro trader. Multiple updates there each week. If you're an active trader, active investor, make sure you check it out. Anyway, I'm going to wrap it up there. Good trading, everyone. Talk to you soon. Bye-bye.